Good morning, everyone, and welcome to our webinar on the Magellan Global Infrastructure Fund. I hope that everyone's keeping well. I understand that the very vast majority of our people dialing in today are in Melbourne, and we've had a little bit of positive news over the last 24 hours with a little bit of loosening of restrictions. Thankfully, that's occurred, and we hope that in a week that those restrictions are lifted again. We hope that everyone is doing as well as possible in these awkward times. We've got a bit to get through today, so we're going to jump straight into the presentation. I will need to go through our disclaimer as a starting point, as we do each and every time. So I think it's really important to reinforce that this is generic advice that we're providing today. Nothing is particular to your circumstances, and naturally, if you do require financial advice or have any particular questions, excuse me, on the investment that relates to your personal situation, please give our office a call and speak to your advisor. So I am excited today to speak to Gerald Stack, who runs the Magellan Infrastructure Fund. This fund has been going for 13 years and 11 months. It has its 14th birthday in July this year. The fund has produced a return of 7.7% per annum since inception. Now, it's important to note that the index has produced a return of 4.9% per annum over the same period of time, which is outperformance of 2.8% per annum. And often the problem when you use annualised numbers is you don't get the sense of the compounding value of that outperformance over a period of time. The cumulative return of the strategy over that period of time is 180% versus only 96% from the benchmark. So it's almost double the return of the benchmark when compounding of the annual returns is taken into account. I'm not sure whether Gerald actively tracks this, but if you look at the performance of the fund over the same period of time, it's actually beaten global equities as an asset class. That's produced a return of 170% versus 180% of the fund. The thing that we like most about the fund is how it performs against its benchmark on also a risk basis. So it's taken 11% less risk as measured by standard deviation when we compare it against the benchmark. And what is really attractive is its downside capture. So how the fund performs in tough markets. And this certainly held up during the awkward COVID period. The benchmark lost 44% over that awkward 33-day period of COVID. The fund produced a return of negative 33%, which isn't great, but only 75% of that really nasty period of time. So I'll introduce Gerald in a moment. Gerald Stack's been at Magellan since day one. He's got a Bachelor of Economics and an MBA from Sydney University. He's a chartered accountant and he chairs Magellan's investment committee. Despite being born in Western Australia, he does barrack for the Swans, so maybe Paul would have been more appropriate to interview him today, but nonetheless, it's me. So welcome, Gerald.
Thanks, Patrick.
How are you doing in Sydney?
We're all doing well here. We're watching you guys, with bated breath. We feel very sorry for you, and we're just praying that it doesn't happen to us either.
Now, the one saving grace is I've been told that it's actually colder in Sydney today than it is in Melbourne, which I find very, very hard to believe because it feels like about 3 degrees and we've had all these awful storms overnight as well. So,
yeah, no, it's certainly pretty cool here today, but I guess we're starting in winter. We've got to expect that.
Now, I've given a very brief introduction to the strategy and the fund of Magellan. Was there anything that you wanted to add to that, Gerald, before we start talking about infrastructure in particular?
No, look, I guess the thing to think about is it's not just me. There's 8 of us who are involved in the infrastructure team. We had 5 guys actually, who have portfolio manager titles. We all cover stocks, so we're all responsible for covering stocks. But the PM guys have all got a reasonable amount of experience. So it's a reasonable sized team on a global scale for infrastructure, and it's certainly a very experienced team. We really haven't. The last person we lost was Dennis Eager, who joined me 14 years ago at Magellan from Capital Partners, was essentially my partner, if you like, in this business. But Dennis retired 4 or 5 years ago.
A reasonable excuse to leave, isn't it, Gerald?
Yeah, he's the happiest man in Australia, I like to think of him these days.
That's good. It's an $18 billion strategy too, Gerald, which is big, isn't it?
Yeah, so within infrastructure, we actually run 2 different strategies. What we call our core strategy, which is a more diversified strategy, typically invests in about 90 stocks. We've only just made that available in the retail space recently, so it's really been an institutional strategy, and the select strategy And we have around about 50-50 in each. So this is really a $9 billion strategy, and the core strategy is similarly about a $9 billion strategy, and collectively around about $18 billion invested in infrastructure.
Cool. Now, infrastructure, it's a very generic term. Gerald, I reckon if I went and surveyed people out in the street and I asked them to tell me what infrastructure is, we probably have 10 different definitions. So I'm really keen to hone in on what infrastructure means in an investment sense.
Yeah.
And more importantly, how Magellan defines infrastructure.
Okay. Well, I'm going to talk to this slide on this issue. It's a constant thing that we're talking about with investors. There's really, if you look at investors globally, when they come to think of infrastructure, they talk about essential assets that provide essential services. You think about that as the provision of transport, toll roads, airports, and like the provision of energy through utilities, the provision of water. These are the demand for these services, very reliable over time. So that's in essence the way that infrastructure typically gets defined. It's a very reliable demand. What we do is to say, ultimately, we think a big part of the argument for investing in infrastructure is that it's different to other things. And the way it should be different is that cash flows are reliable. So what we want to do is we want to take that first group of assets, there's about 350 of them globally that meet the definition of an essential asset. And we want to strip out anything that, albeit it provides an essential service, it doesn't face reliable cash flows. So for example, one of the things we don't want to invest in is power generation. Electricity, clearly an essential asset. But if you think about electricity coming to you, someone generates the power, you then send it down high voltage transmission lines, you step the voltage down into distribution lines, which come to your home or place of business. But that first bit generation in Australia, the average price of electricity back in 2019 was $90 a megawatt hour. And compared to that $90 average, the maximum price was $14,000 a megawatt hour. And the minimum price was negative $550 a megawatt hour, where the power companies were paying you to run your air conditioner. So you've got a very volatile price, and therefore a volatile earning. So we don't want to be there.
Bit of a difference. Sounds more like a commodity than an infrastructure asset.
Very much. We would regard electricity as the perfect commodity, really, because it's use it or lose it. So we don't want to invest in commodity price. We don't want to invest in competition. We don't want to invest in sovereign risk. Sovereign risk really means no Russia, no China, places where we can't rely upon the rule of law. So what we're after is very boring, reliable series of cash flows. If I'm doing my job properly, there's no excitement in my work life. Last year, 2020, way too much excitement for me. What I want is a very boring, reliable set of cash flows that I'm very confident will drive value over time. As you talked about, if you look at our returns, 7.7% per annum over the 14 years. No one's going to get too excited by that. But if they compound that with a degree of reliability over time, then you're growing your wealth with a high degree of confidence. And that's our remit. So we're after defensive inflation-linked exposure with low correlation. And the sort of things that we will invest in are on the following slide. Is that coming up? Not yet.
Just stuck on the last one at the moment, Gerald.
There we go.
There we go.
3 buckets: utilities, where 75% of the earnings is regulated, transport infrastructure, airports, toll roads and the like, and then social infrastructure, hospitals and schools, where you really are more like government leases. Social is a very small part of our listed universe. It's about 1%. There's about 130 companies that we invest in really in the utilities and transport space. So we rule out about 2/3 of our potential universe by being focused on these very reliable, predictable income streams. So that's the way that we define it. It's a very conservative view of what infrastructure is. And infrastructure by its nature is a very defensive, conservative universe. So that what we're trying to do is make sure that we're not, we want to grow wealth as fast as we can, but this is not a get-rich-quick scheme. What it is the idea behind what we're doing is that we're growing your wealth with a very high degree of confidence. We'd be very disappointed if we don't grow people's wealth at inflation plus 5% over the longer term.
And I think that's come through in the numbers there, Gerald. It's all good to talk the talk, but you've got to walk the walk to beat the benchmark considerably and take on 11% risk. And that downside capture really highlights the sort of view you have of infrastructure coming through in the numbers.
Yeah, what we're trying to do is to limit our downside capture. So we do well typically in markets that are falling or going sideways, but we should do well, we're going to do less well when markets are rising hard. So when internet companies are trading at multiples of revenue, that's going to be a bit of a struggle for us relatively. We'll still do okay in absolute terms. We'll continue to deliver inflation plus 5, but the challenge for us and what we've done well in over time is to deliver inflation plus 5 when things aren't doing so well.
Yeah. Now, just to be clear with this dashed line on the page here, Gerald, those below the line, those are the
Anything below
assets.
the line,
Yeah.
we exclude. So these
Yeah,
are
I haven't seen any. I
typically-
haven't seen any prisons in the Magellan portfolio, so I thought they were the ones being excluded.
Yeah, no, absolutely. Satellites, prisons, power generation, they're probably the three things that are very investable for us, that they are in our universe, but we exclude them.
Now, we've sort of touched on this already, but there are so many asset classes out there. The number of asset classes seems to grow each and every day. Why do you think investors should have infrastructure in a diversified portfolio?
Yeah, so I think there are, at an absolute level, the thing about infrastructure is it will grow your wealth with confidence over time. If you get the definition right, it sort of looks after itself. That's not to mean that from any given month or year that things might not be wonderful, but over a 3 to 5 year time frame, ultimately share prices reflect cash flows, and the cash flows in these businesses, defined appropriately, are very reliable and predictable. So hence we have this high degree of confidence of growing wealth. So that's an absolute level. The broader argument is that in amongst a portfolio, what you want to be is diversified. And diversified means that you're not betting on any single horse. You're betting on, essentially you've got a box trifecta or quadrilla, if you like. So you're betting in a range of different things, and something will always do well. So infrastructure might not do well, as I said, when markets are rising very hard, but it will do relatively well when markets aren't doing so well. So it gives you, because of we've defined it as tightly as we have, we can be confident that it's got a very different driver to equities globally. So it gives you diversification benefits, as well as giving you a very high degree of confidence about growing your wealth over time.
Yep, perfect. Now, I hope you can remember this, but we had a conversation on the phone. I don't think everyone was perfectly teed up with Zoom and Teams and all these sorts of things, but very, very soon after things started to get nasty in COVID. And infrastructure was an asset class that was significantly impacted by that initial period of COVID. And one of the better explanations I've heard for this, Gerald, is what we went through being an economic crisis caused by a health crisis and not the other way around. So could you maybe talk about how the pandemic impacted the portfolio and also what actions you took on behalf of investors, which at the time I found fascinating?
Okay, so let's have a look at what the portfolio looked like back in January 2020. So this is the way that we sort of think about our portfolio. The yellow and orange pieces are utilities. The blue and grey are infrastructure. So that's the way we think about our world, regulated utilities versus transport infrastructure. So you can see pre-COVID, roughly 32% of our portfolio in regulated utilities, about 58% in infrastructure, about 10% in cash at that point in time. Of that 58% in infrastructure, 17% in airports. So we're overweight infrastructure relative to our universe. Our universe is about 40% infrastructure and about 60% utilities. So we're overweight infrastructure, and we were overweight airports. The natural weight for airports would be about 7-8%. So that was a uniquely bad time to be overweight airports and to be overweight infrastructure, because what the pandemic did was disrupt transport for our universe. It meant those assets that were involved with the transport of people or goods were going to struggle. So airports and toll roads in particular, rail to some extent, but airports and toll roads in particular, whether you're involved in the transport of people, clearly in a pandemic where everyone's inside, there's not going to be a lot of that happening. So airports got hit hard, and I'll show you exactly how hard in a second. Toll roads similarly got hit pretty hard. Utilities, on the other hand, did exactly what we would expect. There are about 80 different utilities that we follow, and of those 80 utilities, 77 of them either met or exceeded their earnings guidance for the year. So that is, at the start of the year, most utilities put out guidance for what they expect to earn for the year. So before COVID was a concept, before Corona had ever been heard about really in public discourse, these utilities had put out their earnings guidance for the year. And come the end of the year, notwithstanding all the drama that went on during the year, 77 of 80 of them met or exceeded what they expected to achieve at the start of the year. So utilities aren't affected by this, but clearly transport assets definitely affected. Now, so what we did in our portfolio, what you'll see is this is our, at the end of the year, at December, you can see we've gone from 32% to 46% in utilities. So we've ramped up our investment in utilities, and we've reduced our investment in infrastructure from what was 58% down to 45%. And in particular, we reduced our interest in airports. Airports at the end of the year were about 8% of our exposure. So we sold down airports, we reinvested in utilities. And if you think what we were trying to do, if I go back to that thing about trying to limit downside and be very confident about growing wealth over time, what we were moving away from were those things where there was a high degree of uncertainty, and we were moving towards those things where we had a high degree of confidence about the eventual outcomes. And for us, that was utilities, and in particular, North American utilities. North American utilities did well.
Understood. Now, and sorry to sort of hone in on the airports, but you went from having an overexposure to airports and you reduced that exposure. What was the sort of process you went through, Gerald, in terms of working out which airports you wanted to keep in the portfolio and which airports you didn't want to keep in the portfolio?
So I guess we first became aware of COVID, as I say, Corona as it was then called, in sort of January of 2020, late January. We started to hear murmurings of that. So what we did was we engaged with a couple of epidemiologists and an ex-director of the World Health Organization and talked to them about what they were seeing and how they expected this to develop. And we also drew upon the experience of SARS from the early 2000s and how that played out. And so the advice that we took on board was at that point in time, it was expected that COVID would be a regional rather than a global event, as SARS had been. And as a consequence, it was going to impact in particular China, and for us in the aviation world, Chinese passengers. So what we did was to sell down the interests in those airports that were most likely to be affected by that. So for us, that was Sydney Airport and Auckland International Airport, both of which have around about, well, in the case of Sydney, about 40% of their passengers are international travellers. In the case of Auckland, it's more like 50%. And of that, China is the largest group, and the Chinese passengers are high spending passengers, so they're high margin passengers. So we wanted to move away from those two airports. As it turned out, it was a global pandemic, not a regional pandemic. So the better thing for us would have been, in retrospect, to sold down all our airports early rather than a little bit later as we did. But in the first stage, what we did was to sell down out of Sydney and Auckland. And early March, around about the 9th of March, it became clear to us it was a global issue. And at that point in time, we sold down out of a range of other airports that we were also holding. ADP, which is Paris, Fraport, which is Frankfurt, and AENA, which is the Spanish airport system. So we sold down collectively. As I said, we had been at sort of 17, 18%. We sold down to about 5% at that point in time. So there was a two-step process. Then later in the year, as we gained confidence about the way that things would come back, first of all, there was a share price reaction. Those airports bounced back up. So that took us to about 7 to 8%. In the meantime, what we did was rejig. So we went back to Sydney and Auckland international airports when they did capital raisings. They went and asked for more equity from shareholders, and they did that at deeply discounted, in other words, cheap prices. So we took back a stake in Sydney and Auckland at that point, and we took money out of our other exposures. So we basically held our airport exposures where they were over the course of the year. We let them rise with share price appreciation, but we rejigged the order according to where we saw value.
So now we're going to stay on the transportation stocks.
Yep.
We talk about this recovery in an economic sense at the moment, but it's still pretty difficult in this global travel space. And what are your views around how it plays out from here, and how do you view the airport and transportation stocks at the moment? Because things are sort of starting to get back to normal, but particularly as Australians, we're not getting on planes and flying to other parts of the world at the moment, are we?
No, exactly. So this shows you what's happened to global passenger demand over time. So in April last year, passengers were down around about 94% globally. And you can see they've just progressively recovered over the next 12 months or so. A little bit of a blip there in March, but just slow recovery. This is global passengers, domestic and international. For the month of April, the data's just come out last night. International passengers remain down 87%. So domestic passengers are back, have recovered much more quickly than international passengers. And if we think about Australia, then that's not surprising. Indeed, in China, international passengers are now currently running above where they were at the same time in April 2019. So we've seen domestic recoveries generally, but internationals are a little bit slower in returning. As we look to the outlook, what do we think? Well, this is IATA is the Global Airline Alliance, and they're sort of saying that they expect to get back globally to 2019 levels in around 2023, maybe 2024. Well, originally they said 2024, now they're saying 2023, so they become more optimistic. Okay. The airports are a little bit more sanguine about this. So the airports who we deal with more directly rather than the airlines, they're sort of taking 2024 through to 2026, 2027. But, I certainly can tell you that in discussions we've had with different airport CEOs over the last couple of months, we're finding them getting more optimistic over time. So we expect to get back to 2019 levels, let's say 2024 to 2026. In that period, there remains a wide range of uncertainty, but certainly things are getting more optimistic as the health outcomes improved. In other words, as successful vaccines have been found, and it's been shown that those vaccines deal with the different variants. They keep people out of hospital and keep them from dying. They might not necessarily keep them from getting sick, but they have some degree of efficacy. So we're seeing that improve over time. Our forecasts are probably not dissimilar to this. We're sort of expecting numbers to get back there in 2024, 2025, around that period. Provided that's the case, airports do look cheap to us, but there remains this wide range of uncertainty. So the decision we're looking at on a daily basis is how much uncertainty are we willing to take in terms of our portfolio. At some point in time, we will go back to airports, and it'll be a judgment call on how much uncertainty can we live with. As I said, at the current time, we're about 8% in airports. We'd look to increase that weighting at some point in let's say in the next 12 months.
That's about benchmark at the moment compared to the index?
Yeah, that's essentially, that's about, in terms of when we think of our universe, that's about what we think it represents, the universe represents. It's about 8-9% airports.
Okay, cool.
Now, so I'm going to move to toll roads, if that's okay, Patrick.
Yeah, of course. Yep, that would be the next one, toll roads.
Two types of toll roads, urban and interurban. Urban is transurban. They exist in a single urban centre, Melbourne, Sydney or Brisbane. Interurban, I'm showing you Atlanta here. These are networks of roads. So Atlanta owns a road network in Italy, one in Spain, one in France and one in Brazil. And these different lines are those different countries. And what you can see, again, is sort of April, May last year, where these charts starts, traffic down anywhere between 50 and sort of 80%, depending on the jurisdiction. And then it progressively recovered as the health outcomes improved and economies opened up. Then we had the second wave. So you see that in sort of around Christmas time, the traffic numbers worsening to be sort of down 40%. And then most recently, if I come right to the end, we can see Brazil trading above. But if I move from Brazil to Europe, you can see Italy, the dark blue line ends up slightly heading towards 0%. It's about 10% down. Other jurisdictions, Spain and France, a little bit worse. And what we've seen is, again, is as health outcomes improve and governments open up economies, the traffic comes back. If they have a worsening of the health outcomes, then traffic worsens again. But we are confident that traffic will come back here and come back pretty quickly. Same thing goes with transurban. So transurban here, we're looking at Sydney, Melbourne, Brisbane, and then the collective group. You can see again in April, traffic down sort of 55% in the major centres. By February this year, Melbourne's down 26%. Sydney and Brisbane are actually trading above where they were in 2020, and this was before the COVID had an impact. So in Melbourne, where clearly we've had a second, if not a third wave, it's taking a little bit longer for that traffic to come back, but we're seeing it come back pretty quickly. And we'd be optimistic that over the next 18 to 24 months, we're going to see traffic essentially return to where it was before. And the reasons are pretty simple. Ultimately, traffic in a catchment is a function of the total number of people living in that catchment and the total number of businesses. Now, population growth may well slow in Australia, but it's not going to go backwards. Similarly, economic growth may be slower than what we expected. At the moment, it actually looks a little bit stronger, if anything, but we're not going to see a wholesale reduction in the number of businesses in those different areas. And as a result, the underlying traffic levels are not going away. So we're optimistic about traffic both in interurban and urban roads. We would say, as I said, over the next 2 or 3 years, we'd be back, not just on 2019 numbers, but back to the trend line. Airports, to put on the other case, it's going to take a while to come back, and we think that trend line has fallen a bit. And
the obvious question with toll roads, Gerald, is around how working from home potentially impacts upon toll road traffic. I think I'd be negligent not to ask that.
No, absolutely. So working from home, it then depends how many people are actually using the toll road to come to and from work. How much of your traffic is commuter traffic? Transurban has put out some data that suggests that roughly 20% of their traffic is commuter traffic. What we've allowed for in our forecast is about a quarter of that to go away and not come back. So in our forecast, we're assuming that basically a quarter of people don't come back to the office, or that 1 in 4 days is working from home as compared to the past. And not even allowing for that, toll roads look attractive to us.
It's fascinating that Sydney and Brisbane's numbers are higher compared to the same month in February.
Yeah, now then what may well be an element of people being uncomfortable travelling on public transport at the current time. But we think that's, that we'll have to watch and see how that plays out. But that looks pretty limited to us at the moment.
Now, you mentioned at the start, Gerald, you don't like to get too excited, as most chartered accountants don't, but I think infrastructure as an asset class at the moment is one of the more interesting asset classes, because we've spoken about the impact of the pandemic, okay? And I think that the second elephant in the room is interest rates and inflation. And I think most investors are starting to ask questions around what are the impacts of potentially higher inflation, higher interest rates, because we have had this tailwind of low interest rates for a very, very long period of time. And whilst it doesn't look like the short-term rates are going to increase anytime soon, we have seen the long part of the curve start to raise. So I'm keen to understand how a higher interest rate environment impacts infrastructure as an asset class. And I'm sure you'll split that up into different sectors, but generally overall.
Yeah, absolutely. So when we think about the impact of interest rates, we think about two things: the impact upon the actual business itself, and then the impact upon the valuation of the business. So as I've talked about already, we think about our world as utilities and transport infrastructure. Utilities are regulated. So that is, they price their product, generally the transport of energy or the transport of water. They price their product so that they earn a fair return on their capital. So they're normally allowed to earn around about a 9.5% return on their capital, if you like, a 9.5% return on their equity. And they price their product so that they get to that. So if inflation means that their costs go up, they get to put their prices up. They go back to the regulator and they get permission to put their prices up. So inflation's a pass-through for those guys. So it doesn't really affect their P&L. Similarly, for transport infrastructure, you generally have inflation linkages in your pricing. So you think about the tolls on a toll road. They are typically automatically linked to inflation. So if inflation goes up, they go up. And provided you don't have it, you don't get a hit to your volumes, then your revenues will go up. So you're protected from inflation. That's part of the beauty of infrastructure and part of the reasons we can be confident we'll grow wealth over time. You're protected from inflation at that level. So that's the impact upon earnings. If we think about the impact upon balance sheets, well, that is their debt. What you've seen with all of these companies is they've increasingly been lengthening the tenor of their debt. So that is that they've been going for longer and longer term debt at what we would regard as very cheap rates. Here's some recent debt raisings, and you can see, if I look in the middle there, Zurich Airport raising 200 million of 7-year bonds at 0.1% per annum. Like that's, you don't get much cheaper than that. So that
I might go and ask them for a home loan, Gerald.
Yeah.
Goodness me, 0.1%.
Very low rates of debt. And that's what all of these companies are doing. So if I was to go back to when I started here at Magellan 15 years ago, we started the fund 14 years ago. At that time, your typical company in our portfolio had about a 3-year average tenor to their debt, whereas the portfolio today, the average duration of the debt is about 10 years. So
Incredible.
they've lengthened the debt and they've locked in at very low rates. So if interest rates rise, it's going to be some time before it impacts their balance sheet. So these guys are okay on earnings, they're okay on balance sheets. Their fundamental business is largely unaffected by a rise in interest rates. So then what happens to valuation? So there have been really 3 major times in the last decade where interest rates have risen. 3 times where rates have risen by, we're showing 90 basis points each time. And so that's what's happened, that those charts show you the increase in the interest rate over that time. Each of those times, MIF, the Magellan Infrastructure Fund's taken about a 5 to sort of 10% hit to its value. So if interest rates go up, infrastructure will come down over typically about a 4 to 8 week period. So there's that. It's a sort of like a knee-jerk reaction. People in the market believe that infrastructure is impacted by interest rates. Interest rates go up, they sell, or certainly there's less buying goes on. So that's what happens in the short term. But then if I look, this is the Magellan Infrastructure Fund share price chart over the longer term, and those 3 orange circles look at what each of those 3 interest rate rises. So you can see over the longer term, it's been largely irrelevant. So in other words, what's tended to happen is interest rates go up, infrastructure comes down over, let's say, a 4 to 8 week period. Over the next 4 to 8 weeks, it comes back to where it started. And then over the next 4 to 8 weeks, it comes back to the trend line. And that's what we've seen progressively over time. So we do expect this, provided interest rates are within a reasonable range. We wouldn't be too surprised later this year, for example, that if interest rates rose by 1%, we would see that sort of 5% hit. But very quickly, we would expect to recover that over time. In other words, infrastructure, because it's protected from inflation through those pricing mechanisms, is well placed in that inflationary environment. That doesn't mean that in the short term it won't get hurt, but over, as I said, what I would still regard as the short term, but over let's say a 16 or a 24 week period rather than an 8 week period, we'd expect to be back and trading in line with where we expect fair value to be.
So are there any sectors that you're trying to avoid, conscious of the fact that we are going to see longer term rates are increasing, or?
It's not so much sectors as it is individual companies. So individual companies will have certain situations where an increase in interest rates or an increase in inflation might hurt them. So, for example, Transurban's, some of its roads, about 60% of its roads, have toll increases that are the higher of 4% or inflation. So if inflation's running below 4%, that's very, very extremely valuable to Transurban. So if inflation goes from 1 to 2%, that actually hurts Transurban until it gets to 4%, and then thereafter it's fine. So there are particular pockets where you have to think about that, but there's no real single sector that causes us too much concern.
Okay, now we've always, I know it's a long time ago now, and thank goodness we've stopped talking about it, but I do need to ask about the US election result. And is there anything in terms of the change of the US leadership that impacts infrastructure as an asset class? And let's restrict the discussion to infrastructure, yeah?
So there's really 3 types of assets we can invest in the US: regulated utilities, communications infrastructure, which is mobile phone towers, and rail. There are no pure play toll road or airport opportunities. So they're the 3 types of assets: utilities, rail, communications assets. So utilities get a 9.5% return, and tax is a pass through. So if when tax rates went down, that their return that they earned, they didn't benefit. Utilities didn't benefit. Similarly, when tax rates go up, they won't get hurt. It's a pass through for them. So they're unaffected by the likely increase in tax rates that we're going to see from Mr. Biden. Similarly, communications assets are held in sort of trusts. So again, these are tax pass-through entities. So in other words, it's the end investor who pays the tax, not the company. So once again, they'll be unaffected by any increase in tax rates. Rail will be affected by the increase in tax rates. So to the extent that there's a significant tax increase, that's something that we need to think about for rail. So that's tax. Then I think the other major Biden initiative that we're looking at is an increase in spending, and in particular, that's going to be focused around clean energy or decarbonisation. Electric utilities are a massive beneficiary of this. So electric utilities, the grid, are a beneficiary because if we're to get to net zero around the world, there's a few things that need to happen. 1, there needs to be a significant increase in the amount of renewable energy. 2, there needs to be massive electrification of economies. 3, there needs to be the use of gas or nuclear as a transition fuel, so the replacement of coal and oil with gas and nuclear. And 4th, then we need to actually find a way to make hydrogen work economically. Now, for our electric utilities, the first 2, the increase in renewable energy and electrification of economies, are massive benefits to regulated utilities. And that's because if every time you create a new renewable energy facility project, it needs to be connected to the grid. So there's CapEx that actually has to happen, and regulated utilities make a return on that CapEx. That's their capital base. Is by growing their capital base, that's how they grow their profit. So they benefit from that. Then secondly, the electrification of economies. If we're to electrify economies, and electrification of economies essentially means the replacement of the internal combustion engine with electric vehicles. So if we're to do that, then there needs to be massive amounts of investment in the grid, both in transmission, the high voltage lines, and in distribution, the low voltage lines. So last year in the US was a record. Indeed, the last 5 years have each been record years for investment in the grid in the US. That level of investment needs to keep growing at around about 8% per annum for about the next 20 to 30 years. So there's a significant amount of money that needs to be invested in the grid. And again, it's electric utilities that benefit from that. So overall, two major policies for us to think about: tax and their infrastructure plan centered around clean energy or decarbonisation. On tax, it's rail we need to think about as potentially having a negative impact on. For our other investments, it's irrelevant. The decarbonisation, electric utilities are a massive beneficiary for that.
Good. We were able to talk about the election without mentioning his name, which is great. Now, we do ask our clients for questions, Gerald. So thanks to all of our clients that emailed in and asked questions. And we're going to get to some direct stock examples within the portfolio, Gerald. So the one that we got the most common question about was Transurban. Now, correct me if I'm wrong, but Transurban is still the largest exposure in your portfolio?
Yeah, approximately 7% of our portfolio. Over time, it's been anywhere between around about 10% of our portfolio and about 3% of our portfolio. Yep. But it's been in the portfolio since 2007.
Yeah, long time. Now, I must say I've had some very mild-mannered clients swear when we talk about Transurban, because as Victorians, we're very used to getting on their toll roads and getting our credit cards hit every month. So could you please talk about Transurban as a stock? Yep. And why it's the biggest exposure in your portfolio at the moment?
Okay, well, so Transurban owns interests in 21 different toll roads around the world. It's clearly a significant position in the eastern seaboard in Australia, but also owns significant assets in Washington and Maryland, and also in Montreal in North America. They've got inflation-driven or better toll increases. I talked about that before. So you've got this underlying reliability in terms of your pricing. And if you think about the catchments that they're in catchments where population is growing. So when population is growing, you build toll roads because the free roads are full and the government is broke, essentially. So if the population continues to grow, that traffic that comes with it has really only got one place to go, and that's the toll road. That's where the capacity is. So there's underlying traffic growth, the pricing is attractive, and they've got a range of particular different development projects around the world. I might add, in the US, they've got some assets where they're dynamically priced. So what they do on these assets is there might be an existing 2-lane or 3-lane highway that's free. They build a lane next to it, and those 3 lanes, this is particularly around Washington, are full basically all the time. So you can elect to go on the toll road instead, but you can see the free road next door, and they set the price for the toll road depending upon how much traffic is on the free road. So the price can fluctuate, from cents to like $30 or $40.
Nice if they did that in Melbourne, Gerald, when the city link's at a standstill. But anyway,
it's highly efficient, but what it does allow them to do is to actually participate, to earn significant amounts of money from that. So there's real opportunity to maximise the amount of revenue out of that toll road. It's good public policy in that it does make sure that you can get to your endpoint quickly, but you've got to pay for it. You've got to pay for that service. So there's a bunch of reasons there why we like it. As I said, underlying traffic we expect will grow robustly over time. The pricing is attractive, the pricing regime, and there's some additional things additional options, if you like, that they have. And you see that in particular in terms of development options in what's going on in Brisbane, Melbourne, and Sydney. In each of these cities, they essentially own the toll road network. So to the extent that government wants to do anything, they're the natural guys to go and play with. So there's always incremental projects that can be done. None of those projects by themselves are get-rich-quick schemes, but they add to the total value opportunity that Transurban can deliver for investors. So a bunch of reasons why we like it. I might add, it's actually the largest urban toll road operator in the world and one of Australia's unsung champions. I mean, it is a global business, and they are unquestionably the best in the world at this stuff.
Now, this is a very Victoria-centric question because it gets a lot of press here, Gerald, a lot. You've got no idea. The Age love writing about it, but the Westgate Tunnel and how that impacts upon Transurban and, financially, how that could negatively impact on Transurban, or maybe the truth about that, if you could enlighten us.
The soil?
Yes, yes,
yeah,
the
look,
soil. Goodness me.
I don't think we have any certainty around that, but I can tell you that we'd expect it that there will be a settlement, and that each of the major parties, the contractor, the government, and Transurban, will contribute to that settlement. In the context, I actually don't think Transurban has to settle here. They could hold out, but if you think about who their counterparties are, that is the Victorian government, and who they enjoy a very good relationship with, and they want to make sure they enjoy a good relationship with. I think it's important that they help to find the optimal solution. So we'd expect them to contribute to that settlement. We don't think it's going to put our value equation for Transurban at risk, but we have allowed for an amount for them to settle in terms of the way that we value Transurban.
Understood. And it's nice to have some perspective on the matter, Gerald, because I love writing about it on the papers. Now, I want to go to a very different stock, one that I picked out that I don't think many clients would have heard of. It's a business called Crown Castle.
Yeah.
So could you talk to us a little bit about Crown?
Yeah. So all of us today rely upon our mobile phones. We rely upon mobile data. And the volume of mobile data that's gone through networks globally has grown around about 290 times since 2009. So we're using around about 290 times the level of data through communication networks than we did back in 2009. And as we look out over the next 5 years, there's some of the larger US communication companies are putting out forecasts that suggest that the amount of data that will grow at around about 30% per annum for the next 5 years. So the use of data is what underlies this. So as we use more and more data using things like Google Maps, video apps, you're in Victoria, so afl.com.au, Facebook, all of these things, they chew up at huge amounts of data. And as we're using them always on the run, you don't even have to walk down any major street to see people attached to their phones as they're walking down the street, bumping into light poles and the like. So the use of that data means that we need to have communications infrastructure in place. And there are really three key types of communications infrastructure. One is the big mobile phone towers. And secondly, then we have what we would regard, or what we call small cells, which often sit on the top of telephone poles or electricity poles, or even on top of buildings. And these would be, around about the size of, a Rubik's Cube, or even a little, maybe twice the size of that. And so the big mobile phone towers interact with those small cells. And then we have optic fibre that connects those small cells to a processing facility. Crown Castle owns 40,000 macro towers, 40,000 of the big towers across the US. It owns 65,000 small cells and about 65,000 miles of fibre. And so that map that we're showing you there, all those purple dots represent towers. The red dots represent the small cells. So the small cells typically exist in urban settings. So you'd have a huge number of small cells within the CBD in Melbourne, as we do here in Sydney and in Brisbane. So they sit within urban areas because a single tower can't connect to all the mobile phones, so it can relay the service across small cells. So you have these small cells in those urban areas. So Crown Castle owns the infrastructure that helps drive all that mobile data, that mobile communications across from between people. So that's what we're investing in here. It's a beneficiary of the fact that data volumes are going to continue to grow. And it's also a beneficiary, I'd say, at the moment, that from the fact that everyone's been sitting at home for the last year, coming to understand that the high quality broadband is really kind of important to the way that we live our lives these days. So as a result, these guys have continued to grow their data volumes. They continue to grow their cash flows. And as we look out, we expect them to grow their dividends per share at sort of 7 to 8% per annum over the next 5 years. And there's a very strong fundamental story behind what's going on. Again, as you say, not many people will have heard of this, of a company like this, but are really completely essential to the way that we live our lives.
Now, one of the things I find interesting with Crowd Castle is, and I don't like GICS sectors, Gerald, putting stuff into buckets, but it's actually a REIT. It's a real estate investment trust. And I know you don't sort of watch what your competitors are doing, but I guess many infrastructure managers would exclude a business like that from their universe because it doesn't fit in the index.
Look, I think most, there are, you're right, I'm not 100% sure exactly about how everyone else treats it. We tend to ignore the GICS codes. GICS codes
very sensible.
Well, they just haven't been developed with infrastructure in mind. It's actually not abundantly clear to me the GICS codes, which is the commonly used industry classifications across the investment industry, exactly how they've been developed and what the thinking is behind them. Because REITs is really around a structure. REIT stands for Real Estate Investment Trust. It's around the trust structure. So yes, these exist on real estate and they're in a trust structure, but they're not real estate as I would understand it to be. So I think most infrastructure investors would include telecommunication tower companies in the grouping, in the infrastructure grouping. As I say, from our perspective, they are absolutely essential assets. They certainly have very strong franchise, monopolistic power within their local environment. That we would think them at their front and square when it comes to how we think about infrastructure.
Interesting. And, there's this debate at the moment versus old and new infrastructure. Would you describe this as being new infrastructure?
Yeah, this was something it took us a while to come to grips with when we first became across it, which was sort of 10 or so years ago. It wasn't in our original defined universe when we first started at Magellan, probably about 12 years ago. So it's a newer form of infrastructure. There are other things such as charging, motor vehicle charging networks, electric vehicle charging networks. Now there's no standalone electric vehicle charging network that we can invest in today, but we would regard that potentially as an infrastructure asset.
Interesting.
Data centers, we don't regard as an infrastructure asset, but there are some who do. So these are typically industrial property type buildings full of computers which are storing data on behalf of businesses really around the world. They to us look more like industrial property than they do infrastructure. But there are a range of these sort of things that are on the edges, if you like. Renewable energy is another one. Renewable energy for us is power generation. So if they've got a long-term 15-year take or pay agreement, that meets our criteria. But if not, then they're subject to the prevailing energy price, and therefore we're going to exclude that. So we come at this ultimately with our definition in mind. Is it providing an essential service, and how reliable and predictable are the cash flows?
Seems like a much more sensible way of doing things rather than looking at a benchmark or an index.
I hope so.
Yeah. Now it's crystal ball time now, Gerald. We need an outlook for the portfolio and the asset class generally, which I know is tough with everything that's going on in the world at the moment, but it's tradition.
So I think interest rates are a key driver of the way to think about what we're likely to see in the next little while. As I look out over the long run, we talk inflation +5. We're thinking if you define infrastructure the way we define it, over the long run, you should achieve inflation +5. So over the long run, that's what I expect. Over the next 1 to 3 years, clearly whether or not we get some inflation, that will be a key driver over that period about exactly where we get to. So if our base case is that we do see some inflation this year, that it's transitory, that it's not structural. So in other words, it's sort of, we have an inflation
coming off the low base.
But it's not something that we get stuck with forevermore. If that's the case, then we probably, when the inflation presents, we'll probably see infrastructure take that sort of 5 to 10% hit that I talked about, but we'd expect to recover that pretty quickly. If, on the other hand, inflation is structural rather than cyclical, so inflation, let's say it goes to 6 or something like that, and it gets embedded in the system, we have sort of 4 to 5% inflation for the next, 5 years. This is not our base case, but if that was to happen, then we would see interest rates, we would expect with central banks increase interest rates significantly, and that would be a bit of a challenge for long duration income streams like infrastructure or property. It probably doesn't throw us too far off our scent over the long term. We probably still expect to achieve roughly inflation +5, but there's going to be a little bit more of a roller coaster ride along the way. The other alternative is, and heaven forbid, that the vaccines don't, or the virus mutates in such a way that the vaccines are ineffective. It's clearly not that doesn't appear to be the case at the moment. But if that was to take place, then we would expect to see interest rates remain very low and inflation remain pretty low for the foreseeable future. And so if you think about our portfolio today, we're roughly sort of 47, 48% infrastructure and utilities and about 5% cash. If we were to see inflation take off, you'd probably see us go more to infrastructure assets and away from utilities, where we have been historically. And the reason being that you get a volume kicker. In other words, there's more traffic on roads, there's more passengers through airports, and you're still protected on the pricing front. The flip side is if we were to see economies performing poorly, inflation down, interest rates down, that environment that scenario where the virus is mutating, then you probably see us go more towards utilities, because in that environment, volumes are down in infrastructure, but your underlying returns in utilities remain very robust and very reliable and predictable.
Beautiful. Thank you, Gerald. Thanks for your time today. I've thoroughly enjoyed that, as I'm sure all our clients did. All the best. So thank you to all our clients joining us today. Please stay safe and well, and we look forward to catching up with all of you face-to-face when it's safe to do so. Take care.